Here we are in part 3. It's our last part of this course. So a few things we need to go through here. It could be a little bit tricky maybe. So have a look again at this part 3 when you have extra time. Business transactions, sales, purchases, inventory, fixed assets, value-added tax or sales tax, and all journals related to those business transactions. Let's begin with business transactions. Just think about it. Which business transaction you may already know? The business transactions involve sale of goods, right? Sale of goods or services in exchange for money. Purchase of goods and services in exchange transaction, money for goods, other way around. Payment, transfer of funds for buying of the goods and services. Receipts is getting funds from someone for goods and services supplied. And payroll, paying salary to the employees. This is very important concept again. In bookkeeping, you may have to choose between cash and accrual methods. If you already have a running business, you need to understand which method of the bookkeeping is being used. There's two ways to recognize revenue in business. Cash, it means sales invoices and expenses are recognized at date of payment. So it's very simple. You go to supermarket, you buy apples, you give cash for this purchase, and pretty much it happens there and there. Transaction is cash basis. Let's now say we go to the huge warehouse and we buy a large amount of apples for our store, and we have an agreement with that specific warehouse that will pay them within 30 days. So as you can see, the cash date is actually moved for between 30 days period, right? So there's no immediate cash. You can pay straight away in cash, but they give you 30 days to buy on credit. So accrual basis means sales invoices in income or expenses are recognized at date of raising the invoice. So we have a date of invoice here as a crucial date. So when you buy from the warehouse, you get the invoice from the warehouse to pay for the goods, and the terms of payment on this invoice would say 30 days. Although you're not paying until later, your date of invoice is recognized when income is actually received. Once again, so we have cash, we get cash for the payment of goods straight away, or we have 30 days. So we're delaying payment for the cash. But regardless of delaying payment for our goods, we have a date based on the sales invoice when revenue is recognized.